Hello, today is Thursday, April 16th, 2026, and in today's video we're going to take a look at two sessions. We're going to look at first the NASDAQ NQ E-mini futures for today's session, Thursday, April 16th, and we're also going to look at yesterday's session, Wednesday, April 15th. We'll be utilizing the day trading GPS futures CFD's Daily Key Levels V3.0 indicator, as well as an add-on indicator, which is the day trading GPS ribbon indicator. Now, today's video, we're just going to primarily run through the trades of each session. We'll briefly run through how the indicator works. However, if you want more details and full details about what all the different levels mean, how to trade with this indicator, and all the features that are packed into this indicator, as well as going through all the user inputs in the control panel, then look in the description of this video. You'll see a link to a full features and setup video on this indicator. It's a fairly long video, however, it is split up into chapters in the description of that video, and you can simply look in the description and click on the different chapters that you would like to see on different topics, as opposed to watching the whole video. There'll also be some other links to some other videos on this indicator as well that you could see for prior videos that we've done. Okay, so the way this indicator works is at the first tick of the 9:30 a.m. RTH session open, you will get today's key levels at the first tick of the open on your chart. The main key level is the New York RTH session Bull Bear KPL, which stands for key price level. So we'll also refer to this as the BBKPL in this video, so that's what we're talking about. You also see that we have R levels above and S levels below. So we have, as a default, R1 through R6 and S1 through S6. That is because on most sessions, most of your pricing is going to be contained within R1 through R6 and S1 through S6. However, if we do get into extreme volatility situations, such as with the COVID pandemic or with some of the market meltdowns and melt-ups we've had in the past, this indicator also goes up to 10 levels above, so you can go R7 through R10 as well as S7 through S10 as well in those situations as well. You just simply need to turn on the additional levels in the user control panel. The other key levels given by the indicator are the New York PMH level, New York PML, New York YDH, New York YDL, and New York YDC levels. So that is the New York pre-market high, New York pre-market low, yesterday's daily RTH session high, yesterday's daily RTH session low, and yesterday's RTH session close. You'll also see here we have MS4, top overhang, poke below. That is today's market scenario. So at 9:30 a.m. first tick of the open, you will also see up here what market structure scenario we're in. So with any symbol, including NASDAQ E-mini futures, there are only 6 different market structure scenarios that a particular symbol can open up in if it has any pre-market activity. And those market structure scenarios are based on 4 of these 5 contextual levels: the PMH, the PML, the YDH, and the YDL level. This indicator also gives you the ability to turn on a market scenario analysis table. So not only will you know what the market scenario is, but if you want, you can also turn on this table, and you simply just turn it on before the 9:30 a.m. open. And then on the first tick, it will give you an analysis of this particular market structure scenario. So in this case, we'll see that come on. As you can see, it is a fairly large table. It is turned on to the normal size. You can make it smaller or larger depending on your preference. So you can just simply go down here, change it to smaller or larger, and you can also change the position of it on the table. And what this does is it recaps again what session we're in, what symbol, what market scenario we're in, the 4 levels involved in the market scenario, an explanation of what this means. And it also will give you the primary dominant tendencies and key trading characteristics of this particular market structure scenario, which gives you a further guide on how to trade this particular structure. This indicator also has historical market scenario structure labels as well. So you can go back and look at historical sessions, and you can also have the historical market structure scenario label in each one of those historical sessions, as well as look at all of the main key levels and the contextual levels in each historical session as well. That is a very important thing to do as well, because through historical analysis, historical session analysis, you can refine your trading further by seeing how your preferred trade-ups are favored or unfavored in particular market scenario structures. How that can help your trading in the future from doing historical session analysis is that you can see what key levels have the best reactions in each different market structure scenario typically, and how your particular preferred trade setups perform in each of the 6 different market structure scenarios. Any symbol can only have one of 6 market structure scenarios if they have a pre-market, such as the case with most of your popular stocks, and as well as futures, which trade in both in the overnight and the pre-market, and as well as stocks and ETFs like SPY, QQQ, IWM, Tesla, NVIDIA, etc., that also traded in the pre-market starting at 4 a.m. So with market structure scenario analysis, as far as historical sessions, you can, like I said, you can help refine your trading by knowing which market structures favor your preferred setups and which don't. So how that helps you is that you know that if, for example, out of the 6 market structure scenarios, if 2 of those market structure scenarios tend to have the worst performance for your preferred trade setups, then you know when those market structures come up that either you shouldn't trade that day, or if you are going to trade, that you know that you need to be a lot more cautious in whatever way that you're going to be more cautious, either reducing your size and adjusting your stop losses, or doing other adjustments to your trading, or, as I said earlier, just skip those days altogether. And then on particular market structure scenarios that tend to favor your preferred trade setups, then you know that in those market structure scenarios that you can either be more aggressive and maybe trade larger size, or adjust your trading in other ways to trade more aggressively, because you know that historically those particular market structures favor your preferred trading setups. So how that is done is through historical market scenario labels. So we go down here, and you can see here that we have show New York session market scenario label. Then under that we have historical. So if you look at that video I talked about earlier about the features and setup video, you'll see a whole section on historical market analysis, how to set up your chart for it. We go through exactly how to perform the market scenario historical session analysis, and you can look at that in that particular video. But as you can see here, you have a label on your chart here, and this label on historical session will be in all the historical sessions as well. Okay, so now we'll get off this topic and move on. Now, one more thing on this just before we move forward. We also have PDF one-page cheat sheets for all these market structure scenarios. So if you don't like having that table on your chart, you can simply use the one-page PDF cheat sheets. When you purchase this indicator, you will get a very comprehensive and detailed user guided manual, which goes over all the aspects of using this indicator as well as how to trade using the indicator. And then within that user guide manual, there'll also be a section in which there'll be a link, a Google Drive link to the one-page PDF cheat sheets for the 6 different market scenarios. I'll just show you those real briefly and then we'll move on to the rest of the video. Okay, so here is the cheat sheets for the 6 market scenarios. It starts off with a cover page here. Just goes over a brief summary of each of the different market scenarios. And that is followed by a one-page PDF cheat sheet for each one, in which you have the structure, the visual structure, primary tendencies, key trading characteristics, what to expect, and also if part of that structure is traps or reversal zones, it will also include that. Here we have full gap above and full gap below. This also goes into the key level priorities for those which differ depending on the size of the gap. The key level priorities are between the 4 contextual levels that make up the market structure scenario. And what you can do is you can keep these on your computer. If you have multiple monitors, you can simply bring up the one-page cheat sheet as opposed to having the market scenario analysis table on your chart, or you can simply download them, and instead of displaying them on your computer, you could simply print them out and then have them next to your keyboard for handy reference. All right, so now let's go through today's session here. So we have, starting off, the 9:30 a.m. BBKPL, the bull bear key price level 9:30 a.m. opening candle alert, which is giving us a bearish alert for this particular opening candle at 9:30. We're on a 2-minute chart. The recommended chart time frames for the daily key level strategy for trading futures for specifically NQ and ES futures. This indicator does work on many other symbols as well. So it also works on gold, silver, crude oil, Bitcoin futures, Russell 2000 futures, Dow Jones futures, and many other futures contracts as well. However, the most popular ones are going to be the NASDAQ NQ and the S&P 500 ES. It also works on micros, so if you trade micros instead, if you trade micro contracts of any of those I mentioned, it does work on all the micro symbols as well. Okay, so we have the 9:30 a.m. opening BBKPL bearish entry alert. So what this is telling you is that this has closed below the bull bear key price level on the opening candle, giving you the initial bearish bias for the session. This alert only prints if the close of this candle is within the acceptable range. So the acceptable range filter is part of this alert system, and it is down in the alert section. Acceptable range percentage 85%. 85% is 85% of one standard key level, the distance from the BBKPL to R1 or S1. Default of 85% means alerts only fire if the price closes within 85% of one standard key level from the crossed level. You can set this higher if you want. We would not recommend doing that, but you can set this higher. You can also set it lower. Some people may prefer to have it lower. What that means is that it's closing below or closing above. It's just going to be closing above or below, closer to the actual level that the alert is for. As you can see here, this 9:30 a.m. opening candle alert is simply only for the 9:30 a.m. opening candle. And then we have the apply range filter here also checked. We also have crossed and closed above alerts and crossed and closed below alerts for all the key levels, including all the contextual levels, in which each one you can also specify whether you want to apply the range filter or not. The crossed and closed above or below alerts can be used for either bringing your attention to possible entries on closes above or closes below. They can also be used to help manage trades after you're already in trades if you're looking for to get an alert when when price action has crossed and closed above or below a specific level, so you can then be alerted to possibly take action to either exit a trade or for further adjusting your trade. But we're not going to rely just on a close above or a close below a key level. We're also going to confirm our entries with the ribbon indicator. So in this case, what we're looking for is we're looking for confirmation from the ribbon indicator, with the ribbon being all red since this is a bearish entry. So we're looking for the ribbon not to be partially green and partially red, or all green when we have a bearish entry signal. We're looking for the ribbon to be all red. Conversely, on a bullish entry signal, we're not looking for the ribbon to be part red and part green or all red. We're looking for, on a close above, on a bullish entry signal, for confirmation from the ribbon indicator that the ribbon is all green. Now, preferably, you want it to be in confluence with the bullish or bearish entry being the same color, uh, meaning the ribbon I'm talking about, and preferably or ideally that the top lines of the ribbon are starting to expand away from the ribbon. So as you can see here in this close here, they're starting to expand away from the mass. So that is a confirmation of our bearish entry signal here on this close above, excuse me, a close below the bull bear KPL level. Now, if you've seen some of our other videos, there are 3 different types of trades that you can do with this indicator. There's 2 different types of scalp trades, and there is another trade called a regular day trade. So the 2 different types of scalp trades, one is a micro scalp and the other is going to be a regular scalp. On a micro scalp, what you're looking for is a exit at the next contextual level that will be before a 1 level move in your favor calculated from the level that you're basing the trade on. So a regular scalp is going to be a 1 level move in your favor in the direction of the trade calculated from the level we're basing the trade on. We're basing the trade on the bull bear key price level. The direction is down 1 full level. 1 full level below that is the S1 level. So that would be our regular scalp exit. A micro scalp exit would be if one of these levels, and in this case we have 3 levels here, 3 contextual levels that are in the pathway before the full 1 level move. However, in this case, because of this, the extension of this candle is so close to these levels, there would be no micro scalp opportunity with this particular one because it's actually closed too close to these levels. So there's really no reward opportunity for the risk of the stop loss. Now, the stop loss on this trade, on a bearish trade from the bull bear key price level, you have 2 options. The QL level above is your tight stop loss, or the midpoint level above the level we're basing the trade on is your standard stop loss. So it's up to each individual trader to decide for themselves with their own risk profile and account which they prefer to use, either a tight stop loss or standard stop loss. Of course, the tight stop loss, because it is tighter, is going to be more prone to getting stopped out at times. So that's just something you have to keep in mind, and just through practice with the indicator, you can come to the conclusion yourself which one you prefer to use, either tight or standard. On bullish trades, it works in reverse. So on a bullish trade, for example, from the bull bear key price level, your tight stop loss is the QL below, and then the standard stop loss is the midpoint below. Works the same way off of all the other R levels and S levels. So for other R levels and S levels, these are the only QL levels that are turned on by default. You can, of course, change the default settings in the user control panel and turn on other ones, especially if you prefer to use tight stop losses. You simply go in the user control panel, you go down to the QL, which is quarter line settings, and you would simply enable either the QL above or the QL below the specific level. For midpoint levels above and below each level, you do the same thing. So by default, only the first three are turned on. If you want to turn on other ones, then you can turn on other ones. As far as trades off of the 5 contextual levels, the stop losses for that are done in the user control panel. So you would simply go down to this section here. This section is for stop loss and take profit for PML, PMH, YDL, YDH, and YDC. The first section is the bullish entry section for stop loss and take profit. It lists all 5 levels here in a row, all 5 contextual levels, and that is followed by the bearish trade section for this. Your reward to risk multiplier is a standard of 2. It goes down in 0.25 increments all the way down to 0.25. The default is 2. You can also go above 2 all the way to 30 in 0.25 increments. If you don't want to go up, you just know the exact one, and you can just simply, as an example, just type it in. But it has to be in 0.25 increments. So for example, if you want to do 10.25, that's fine, and just type it in. That's how you do that. Here you select either standard stop loss or tight stop loss. If you select one of those two, it's going to print on the screen the tight stop loss or the standard stop loss with the corresponding level. Same thing with the take profit. If you use the take profit for these trades, then it will create a line with a line label for the take profit, and it will also show you the reward to risk multiplier that you used. Okay, here on the ask on the close of this 9:30 a.m. candle, we have 26,373.75. As you can see here on the 9:52 a.m. candle, we have a hit of the S1 level. That is your regular scalp exit here. Remember that there was no micro scalp opportunity here because of the extension of this candle. If this candle was more in this range right here, then you would have micro scalp opportunities to either exit at one of these 3 contextual levels here if you prefer doing a shorter micro scalp trade. However, the regular scalp trade exit is here on the 9:52 a.m. candle, the hit of the 26,305.75 level. Now that is 68 points from the entry, so that is $20 per point on NASDAQ NQ E-mini. So that is a profit of $1,360 per NQ E-mini contract. Of course, if you're trading micros, one E-mini NQ, one regular E-mini NQ is going to be equivalent to 10 micros. So that's how on 10 micros it would be the same profit of 1,360. All right, as you see here, we did get a little dip down here, and then we start moving back up, so there was no opportunity for a regular trade here. However, as you can see here, the ribbon is starting to turn green here and starting to separate. So here on the 10:46 a.m. candle would be your first bullish opportunity here on this close above and taking a trade off of the YDH level. So again, if you wanted to take a trade off the YDH level off of this, you would simply go in, you go down to YDH in that section under the bullish section. Let's say, for example, that we wanted to do a tight stop loss. And then we wanted to do a risk-reward multiplier of, let's say, 4 to 1 or 5 to 1. So as you can see here, here is the bullish tight, that's abbreviated to TI, SL, YDH. And then here is the 5 to 1 reward risk with the take profit on this particular trade. Now you can move these over and you can also make these larger. You can simply go down to the section right above. So here are the SLTP line extension options. It's set to both. And then here's the line label offset. It's currently set to 15. What that means is that it's going to be, the middle of this is 15 bars away. So you can also, it's also set to normal. So if we changed it to large, then you'll see that these change to a larger text. You can also change the color. The colors are individually controlled, so if you wanted to make the stop loss a different color, then the take profit, you can do that. You can just change them to whatever color that you want in opacity. All right, so for right now, we'll just go ahead and turn these off. You also can just use the stop loss part if you just want to do the stop loss and do the take profit based on it hitting one of the other levels above here. So the reward to risk part is optional. You can either use the reward risk and actually do the reward risk multiplier and see what the reward risk is, for example, hitting R1 or hitting the bull bear key price level or hitting one of the other levels, and either step it up or back it back down to get to that, or you can simply just eyeball it. Now the first trade opportunity here, bullish trade opportunity on the bull bear key price level, is on this 11:02 a.m. candle here. And here we have the ask on the close of that candle. As you can see, we have a close above. Now you can turn on these alerts for all of these levels as well. Now, in my particular trading, I prefer to only use the opening candle alert because I can visually see that this is a close above. So I don't need an alert label here. Some people prefer to have the alert labels. I prefer to have a kind of a decluttered chart. So I prefer to just go up visually off all the ones except the opening one. Every trader's different. If your preference is you prefer to see the close above, or close below labels, then you can certainly turn them on. They're individually controlled for each main key level as well as all the 5 contextual levels. That's up to you. We also have a decluttering filter which will only show the last active alert for each particular level for each type of alert, close above or close below. So that is a somewhat decluttering filter that if you want to turn on many alerts and have a decluttered, as decluttered as it can be, chart with the labels, then you can do that. I'll just show you that real quick. Show last alert only. So if you enable that, if you had a bunch of these turned on, what it's going to do is only going to show the last active alert for each enabled alert that you have on for each level that you have on, and that is a decluttering filter. Okay, so on this close here, we have confirmation. The ribbon is all green. We have the ideal separation of the top of the ribbon away from the body. So the close 26,438. Now in this, you can do a micro scalp up to the PMH level, 26,465.75, as that is far enough away to justify the risks on a micro scalp. So on the bullish trade, like we talked about earlier, your tight stop loss on a trade from the bull bear KPL is QL below. Your standard stop loss would be the first midpoint below. Your one level scalp in your favor is going to be the R1 level on this trade because it's one full level above the level we're basing the trade on. In this case, it hits the PMH level right here on the 1108 candle. Now, that is a 27.75 point move, so that is going to be $555 at $20 a point on a regular E-mini contract or for 10 micros. Here on this candle here, we do get a hit of the R1 level, 26,549.75, and that is 111.75 points from the entry down here at 26,438. So that is a profit at $20 a point on a regular E-mini of $2,235, or that amount for 10 micro NQs. All right, so now we're going to take a look at yesterday's session. Okay, so now we're going to look at yesterday's session, April 15th, 2026. So this is Wednesday's session. So as you can see here, we have the opening candle did close below the bull bear key price level. However, we have an all green ribbon here. So this is this 9:30 opening candle closing below is negated by that. So we don't have confluence of the ribbon and the close below. So we're passing on that trade. So if you have a situation like this, where you have the close below the key level, in this case the 9:30 a.m. opening candle, closing below the bull bear key price level, but the ribbon is either partially green and partially red, or the ribbon is all green, then there's no confluence, so there's no trade. So what you're then waiting for is, are we getting a close above or a close below with a complete change in the ribbon? In this case, on the 9:32 a.m. candle, we have a close above, and we have these other candles here also closing above 9:34 and 9:36, and we also have a green ribbon. So on this 9:32 a.m. candle close, we have a green ribbon and the close above. So that is the bullish entry. We're going to take a quick look at the market scenario for this. So this is MS4, top overhang, poke below. We go to the market scenario analysis table. Okay, so we have on here test or potential reversal or breakout confirmation. The market often tests back down to YDH level due to magnet effect, as this was yesterday's high, remains a psychological level that the PMH above YDH may represent. A false breakout or a fake out that fails during RTH, so acceptance testing is critical, meaning acceptance above YDH is critical, and also PMH is also critical. Common pattern, pull back to YDH to test as a new support. If YDH holds as support during RTH, bullish continuation is likely. And that is the same that we have on our PDF cheat sheets. As you can see, top overhang poke below has relatively the same information. The cheat sheet has a little bit more information than what is on the table, on the market scenario analysis table on the chart. However, the core information is the same. So remember, the YDH level is key, holding above that. We have the YDH and the YDC level right on top of each other. The YDC 26,000.75 and the YDH 26,003.25. So they're basically right on top of each other, as you can see. That's right at today's bull bear key price level as well. So here you can see it tries to go below it. It goes back above it here on the 9:32 a.m. candle. It does try again here on the 9:42 and 9:44 a.m. candle. However, the closes back above both the bull bear key price level and YDH and the YDC. So it's holding above YDH, as the market scenario analysis table said is a common pattern with this particular market structure scenario. And the bullish continuation is likely should it hold above. It also said that holding above PMH also critical. So as you can see here, eventually it does hold above PMH here, excuse me, as well. Nevertheless, the entry here, at least the first bullish entry, would be here on the 9:32 a.m. candle right here. The ask on that is 26,035 even. An additional entry that you could also try here, okay, would be, now in this case, the YDH and YDC are pretty much in line with the BBKPL, as you can see here. So the next available bullish confirmation, if you did not enter here, would be right on the PMH level and closing above and holding above, because we have the green ribbon at the time that it's also doing that. This candle here, this 9:32 a.m. candle, is too close to the PMH to be considered a microscalp. So as you can see here, it's closing right about here at this level. This is not enough space considering the stop losses that we have for a decent risk reward. So there would be no microscalp opportunity here, as this is the only contextual level in the pathway before R1, the regular scalp only exit of a one level move in our favor. Again, one level move in our favor on a scalp. You're looking up from the level you're taking the bullish trade from, and then the first full level above that is the R1. Tight stop loss on this trade taken from the bull bear KPL, the QL below the BBKPL is the tight stop loss. If you prefer the standard stop loss, it's the first midpoint below mid BBKPL S1. Here we have the 10:24 a.m. candle, so that is where you can see it spikes above it. This wicks above it. So that is going to be the exit for a scalp, 26,127.75. So on that scalp of the R1, that is going to be 92.75 points, so that is a profit of $1,855 on one NQ E-mini, or per NQ E-mini, or per 10 micros. Now here you can see here we have the mid R1, R2 hit, 26,190. That is happening here at 11:14 a.m. at the first instance. So if you had your sell to close here on that for a regular day trade, remember a regular day trade is a 1.5 level move in our favor, measured from the level that we're taking the trade from, in this case a bullish trade from the BBKPL level. And so the 1.5 level move, this is the 1 level move, this is the 1.5 level move, this is the 2 level move, and this is the 2.5 level move. So on the 11:14 a.m. hit, 26,190, That's 155 points from the 26,035 entry. $20 a point on a regular E-mini contract. That's $3,100 profit. So that would be per E-mini contract or per 10 micro contracts. Now, on a regular day trade, you have two different thresholds that you can use. So you can either use the minimum required 1.5 level move threshold, which would be this level here, or the minimum ideal move on a regular trade, which is a 2-level move. Now, if you've seen some of our other videos, you've seen the explanation of that. Basically, a 2-level extension from the bull bear key price level in either direction. Most of the action occurs on 80% of the sessions throughout the year in a normal year on at least NQ and ES between the R2 and the S2. So a 2-level move extension either above or below. What that also means is that on days where you have a lot of yo-yoing type action, that can also mean, let's say if we had a move down and then a curl back up and starts closing above, and we have a green ribbon above, closes above S2, a move back from S2 to here is 1.5 levels, and then back to here, a bull bear key price level and a bullish trade from S2 is 2 levels. And then, of course, if it moved all the way back up to R2, which we've seen quite a few sessions where it's actually done that, that would be a complete 4-level move. And the same thing here at S1. S1 back to here is a 1-level scalp. Then on a bullish trade from S1, 1.5 level move here, and then a 2-level move to R1. Same thing in reverse, R2, bearish trade. If we had closes below, we had a full red ribbon on a close below scalp, unless we had a contextual level before the 1-level scalp. For a micro scalp, 1 level would be down to R1 for a scalp, 1.5 level move here, and then 2-level move here. Same thing from R1 to here, 1-level scalp unless there's a contextual level. So here, if there was a R1 close below with a ribbon being completely red, okay, then you could look at a possible bearish trade back to either PMH or the BBKPL. In this case, though, we're in a bullish trade on the onset here. So we have a bullish trade starting here at the 9:32 a.m. Now, when it hits the 1.5 level move in your favor, let me expand this back out. When it hits the minimum 1.5 level move in your favor, if you've seen our other videos, you already understand the process here, but for those who have not, 1.5 level move in your favor on a regular trade is going to be the minimum threshold move. When that happens, you have several different options available, and this is what separates regular day trades from scalp trades. On scalp trades, you're exiting either on the micro scalp level or the regular scalp level 100% of your contracts. On a regular trade, if you're preferring to do a regular trade, then 1.5 level move in your favor or the 2-level move in your favor. You have several options. One, of course, is just exiting all your contracts like a scalp. So exiting 100%. Your next option is going to be adjusting your stop loss on all of your position. In other words, retaining your entire original position, but adjusting your stop loss. Adjusting your stop loss to at least break even the price that your entry was executed at, which in this case 26,035, or adding an additional profit buffer on top of that. Now the profit buffer could be anywhere as a minimum of say 4 ticks, 8 ticks, 12 ticks, 16 ticks, 20 ticks, or moving it up to a different level, either like in this case PMH or the mid KPL R1. Or if you want to be real aggressive with that, then you could do R1, but as you can see here, you get too aggressive with the initial profit buffer, then you can get stopped out. Now, the third option is if you are trading multiple contracts of 3 or more. So if you have an account size where you can that's large enough where you can trade 3 or more and you're comfortable in trading 3 or more regular E-minis, then this would apply. Or if you're normally comfortable with either the position size of 1 regular NQ E-mini or 10 micro E-minis. For example, if you have 10 micro E-minis, then your other option would be exiting 60 to 90% of your original position when it hits the 1.5 level move in your favor. So if you were trading 3 uh, regular E-minis, then you would be closing out 2 of them right here. If you were trading 10 micros, then you would close out either 6, 7, 8, or 9 of them, 60 to 90%. Then on the remaining position, which are the remaining runners, you are adjusting your stop loss to either break even, the price that your initial entry was executed at, in this case 26,035, or you are adjusting it, like we said, either like 4 ticks, 8 ticks, 12 ticks, 16 ticks, 20 ticks above, adding on to that. So 4 ticks is a point. So, if you were doing 20 ticks, you'd make it 26,040, or picking one of the levels that are far enough away, such as the PMH or this midpoint here, it's just really up to the trader's choice as to how much you want to add. If you add too much, you're running the risk initially of um, retraces taking out. So you have to be careful of, you add too much to right here, um, that's only half level. So that's just something you have to keep in mind, that if you're going to not exit all of your contracts, you're going to do the third option because you're trading 3 regular E-minis or you're trading 3 or more micros, then 60 to 90% exit, remaining runners adjust the stop loss to break even or break even plus a profit buffer. How much of a profit buffer? This really comes more with time and practice. Another option is that you can also set a trailing stop and just let the trailing stop decide when you're actually going to get out. So that's also another option. There's many different types of trailing stops. It's just how far behind do you want to trail. So again, you want to give it enough room to breathe, not so much that you are just going to get stopped out. Because if you make it too tight, whether you're using a hard stop adjustment or a trailing stop adjustment, if you make it too tight, you're just going to get stopped out most times. And if that's the case, you might as well just exit 100% of your contracts on the minimum 1.5 level move or the 2 level move. If you find it's too difficult to adjust your stops in practice, another thing you might want to just try is just exiting 90% of your, and you still want to at least try to find an adjustment that works. And you might want to start out at, let's say if you're trading 10 micros, just exiting 9 of them at the minimum, leaving 1, and then experimenting with adjusting that 1. That way you've gotten 90% of your profits out, and you're just really experimenting with just 1. Okay, so to recap, when it hits 26,190, that is a 155 point move from the initial entry. So that at $20 a point on a regular E-mini or on 10 micros, that's $3,100 profit before any slippage and commissions. Now right here, it looks like it hits R2, but it actually doesn't. So on this 12:22 p.m. candle, It does fall short on the bid there. The bid only got as high as 26,251.50, and we have 26,252.25. So this brings up another point that we brought up in some previous videos, is that on these exits or on these waypoints for adjustments, you can look at it a couple different ways. One is putting in exactly your sell to close or timing your adjustment on a touch of this level when it trades that level. When the bid trades that level, sell to close, and it will just automatically close out. Or some people like to put it a couple of ticks above, either one tick or a couple of ticks above, or one tick to a couple of ticks, say 1 to 4 ticks above, 1 to 4 ticks below. Because sometimes you will see stuff like this, and sometimes it will just not even return. Now, in this case, it did return, and it actually went up to another level, and actually hit at 3:58 p.m. here. Actually hit this mid R2, R3 before falling off, and then curling back up to it in the after hours. So again, that comes with just practicing with the indicator as to whether you feel more comfortable putting it, say, 1 to 4 ticks below, and that way, when it comes up to this level, you're getting out, or are you the kind of person that likes to, to get something on a wick through? Now, in my opinion, if you're going to do that and not just put it at the exact level, you're better off putting it just before the level. So, in other words, err on the side of caution in the case of a trade like this and putting it, say 4 ticks below. Now, you could put it a couple more ticks below, so 1 to 4 is just kind of like a guideline. If you feel more comfortable putting it up to 8 ticks below, that would be 2 points below. That's fine too. And the same thing in reverse. If you had a bearish trade and let's say it was going down to S1, you could put it slightly above the S1 and then get out before it hits the S1. Or just put it right on the S1. So again, that just comes with practice in what you feel most comfortable with in your process of using the indicator yourself, because every trader is different. Okay, so here it does actually wick through and then it does curl back up again here. So we do have a hit of the R2 level here at 216, so that's 26,252.25. Now that's 217.25 points. So that at $20 a point on a regular E-mini or on 10 micros is a profit of $4,345 per NQ E-mini or per 10 lot of micros. Here on the 3:58 p.m. candle, it does wick and hit the mid R2, R3, 26,376.50. On that, that's a total of 341.50 points at $20 a point on a regular E-mini. That's $6,830 profit per E-mini contract, or on a or on a 10 lot of a micros. So you can see here, if you got out here on 60 to 90%, had a moderate profit buffer on top of break even, then as it continues to move up in your favor, when it hits the R2 level, you take off, you can take off some of your additional your runners that you have left over. And then when it hits the other level, then you can close out. Obviously, this was going into the end of the day, so if you were holding any runners here, then you would want to definitely have them just be closed out. Okay, so if you are interested in purchasing the Futures CFD's Daily Key Levels Indicator, we did have a sale going on through April 15th. That was a big sale that had a promo code that was good for $499 for lifetime access on any individual Daily Key Levels Indicator. Because of the demand that we had from that sale, today is April 16th, so we have now extended that sale through the end of April. So we're not going to extend it past the end of April, so this will be the final remaining time on it. And so now through the end of April, April 30th, so end of day, midnight, April 30th, that's when that promotion will end. We also have the continuing of the promotion for the Daily Key Level Suite, which is over a savings of over $1,100. So it is now $875, and that is for lifetime access for all 5 Daily Key Levels indicators. So that would be the Futures Daily Key Levels indicator we've been talking about today. It would also include the Stocks ETFs Daily Key Levels indicator. That is for use on all stocks and ETFs that trade on U.S. exchanges like NASDAQ, NYSE, and over the counter, etc. So that would be on all major stocks. There's probably about 8,000 stocks and ETFs that trade on all the major U.S. exchanges. It's also for trading big ETFs like SPY, QQQ, and IWN, and obviously big stocks like Tesla, Nvidia, Apple, etc., as well as medium cap and small cap stocks as well. Also, the SPX Index Daily Key Levels Indicator, that's for trading SPX Index options. Also, the NASDAQ NDX Daily Key Levels Indicator for trading NASDAQ NDX options. And finally, the Forex Crypto Daily Key Levels Indicator, which is for trading Forex currency pairs as well as cryptocurrencies. So that is $875 under this promotion, a savings of over $1,100. It includes all 5 of the Daily Key Levels indicators, and it includes lifetime access. We also are having a sale on our day trading GPS ribbon indicator, as well as our special VWAP for the SPX index. So some of you who trade SPX, or you may not be trading SPX, but you may not be aware of the fact that on TradingView you cannot use the regular native VWAPs for the CBOE SPX index or the XSP SPX mini index on TradingView. It has nothing really to do with TradingView itself or any bug or problem with TradingView. It's simply because the data source from CBOE global indices that TradingView gets from them does not include volume data. So if you try to use those native VWAPs, you'll get a red exclamation point that is pointing out no volume data available. And so we have a workaround for that works with an external data source and works very well on both SPX, CBOE, and the mini SPX index, the SSP, which is also from CBOE. So we have a special promo code for those that are 30% off. So all the promo codes for this promotion that is now through April 30th for either $499 lifetime access for any individual Daily Key Levels indicator, or the $875 for the all 5 Daily Key Levels indicators in the Daily Key Levels Suite, as well as the 30% off promo codes for the add-on indicators, the ribbon indicator, and the special VWAP for CBOE SPX. Those will be in the description of this video, and they'll also be in the pinned comment. So again, that sale ends April 30th. We did have one that was the exact same sell that just ended yesterday. However, because of the great demand and response we had from it, we are now extending that sale through the end of the month. So after that, that will be the final. We will not be extending it after that. Okay, so some of you may be wondering, how are these indicators working for people that have already purchased them? So what we'd like to do now is show you some of the feedback and user reviews that have been posted at the indicators on WAP.com. You can see all of these for yourself. We're just going to show you the screenshots of them, but you can just view them yourselves by going to any of those links that you see in the description of this video to purchase any indicator, and you can simply click on the reviews to look at those before you decide to purchase or not purchase. But so what we'd like to do now is in the final part of this video, we'll just show you some of those trader reviews and feedback that we received. Thank you again for taking your time for watching this video today. We hope you enjoyed it. If you did, if you could please hit the like button, as that helps us with the YouTube algorithm, so we greatly appreciate that. Thank you again for taking your time for watching this video and supporting our channel, and we wish you much prosperity in all your future trading. Okay, so for those of you who might be wondering, well, how is this working for people that have purchased the Daily Key Levels indicators? You can go to daytradinggps.com and look at the user reviews and feedback. We've just taken some of them here and highlighted parts of them, but we invite you to go to daytradinggps.com and look at the reviews and trader feedback on our various daily key levels indicators, including the SPX daily key levels indicator. Thank you.